Welcome to the 9th Lámfalussy Lectures Conference, a key forum for European and global thinking on economic policy. A high-level summit with 2,000 international attendees since 2014, featuring inspiring speeches and panel discussions with speakers from around the world, honouring the father of the euro, Baron Alexander Lámfalussy, hosting an extraordinary group of international decision-makers in Budapest to discuss the most topical questions of today's financial landscape. This year, we'll look at the prospects for central bank digital currencies, and we'll aim to define the role of central banks in promoting the green economy. But most of all, we'll engage in a comprehensive dialogue and prepare together for the economic challenges of the future. Led by the Lámfalussy awardees, distinguished professionals at the vanguard of our journey into the future of finance. The Lámfalussy Lectures Conference, Shaping the Economy of Tomorrow.
Dear Excellencies, distinguished speakers, ladies and gentlemen, I warmly welcome you to the Lámfalussy Lectures Conference, named after Baron Alexander Lámfalussy, the father of the euro, organized by the Magyar Nemzeti Bank, the Central Bank of Hungary. My name is Csenge Gabriele Ibolya, and I am honored to be your host today. The 9th edition of the Lámfalussy Lectures Conference series is organized under the title New Dimensions of Central Banking in the Post-COVID Era. The theme reflects that central banks are facing new challenges and are encouraged to rethink their policies to deal with the ever-changing economic environment. Our program starts with a high-level opening session with the participation of prominent members of the central banking community. The speeches will be followed by thematic sessions focusing on two of the most topical questions of today's financial landscape: the increasing interest in central bank digital currencies and the central bank's role in promoting the green economy. First and foremost, I am pleased to invite to the stage Mr. Mihaly Patai, Deputy Governor of Magyar Nemzeti Bank, to deliver his introductory remarks.
Good morning, everybody. Good morning. Dear Excellencies, distinguished guests, we have a very strong audience, and on behalf of the Central Bank of Hungary, I thank you very much for accepting our invitation. We have the head of the Constitutional Court, the head of the State Audit Office, the head of the Budgetary Office, the most influential banker of Hungary, and the chairman of the Banking Association as well. And we have the governors from Austria and Slovakia. Thank you, Peter. Thank you, Robert, for coming. And Madam Mann, thank you very much. We appreciate very much that you accepted the invitation to have the keynote speech today. So, dear guests, yesterday we had a festivity. We awarded Mr. Holzmann with the award, and we had a good drink after that. Today we get down to business. The agenda will be very important, and even the speakers will be more important, and they are up to the level of the subject of this agenda. Before talking about the agenda, let me just not shy away from one important issue, which is we are in a central bank, and if we are in a central bank talking about central banking issues, we cannot shy away not to talk about inflation. Inflation is public enemy #1 these days. This is unquestionable. I do believe that the worst is behind us already. I am talking about Europe and the United States and worldwide. There is already the hope in the forefront, and I would just mention 4 things which, because I am hopeful because of these things. The first one is that, of course, it's not a good news, but the demand management is working as far as inflation is concerned. The demand last year worldwide has contracted. For example, in Hungary, the retail sales were contracting, which is not a good news for a politician, but if you fight against inflation, there was no chance in the history of mankind that without contracting the demand, the issue could have been solved. So this is the first point. Demand management has started to work. The second point is that the raw materials, which we observe periodically, the pricing has already decreased in many, many cases. Our colleagues have a permanent and absolute up-to-date information about this. So definitely, everybody knows about the gas price from last August to January this year. Of course, it's completely different, but generally, if you take the 28 most important raw materials, some price decrease has been experienced already. The third one, and the very good news, is that practically all over the world, the fiscal policies and the monetary policies started to converge as far as the direction of the vectors are concerned. The case was in the past that monetary policies were tightening, but fiscal policies were not tightening. They were expansionary. These days, practically all the political elites all over the world have accepted the rule that the chief vectors of the monetary policy and the fiscal policy should be reconsidered, and the direction must be the same. And the fourth issue, which is important to fight inflation, that all over the world, but especially in Central Eastern Europe, we are experiencing that one part of the inflation is profit-driven. My colleagues have written it eloquently in the December inflationary report. As far as Hungary is concerned, one part of the inflation is rooted in a very high profitability of the industries. So, since it has been discovered, I do believe that the political elite will act accordingly and will help to solve that part of the problem as well. So this is why these were the four things I am quite optimistic. As far as the central bank is Hungary is concerned, I would like to state to you very, very clearly that the Hungarian Central Bank will do its best, whatever is possible, to cooperate with the Hungarian government, and we try to harmonize each and every step with the Hungarian government, because there is no other way than the central bank is cooperating with the Hungarian government. About the agenda of today. So I start with the afternoon. Green economy, green transition. What could be the role of the central banks greening the economy? Helping the economy to have a more sustainable and environmental friendly development. I don't know whether we are lucky or unlucky, but the Hungarian Central Bank cannot hesitate on this, because in August 2021, we got a fourth mandate. Also, the green agenda is part of the mandate of the central bank. And one of my fellow deputy governor is in charge of the green economy. He will be the coordinator of the afternoon. So definitely we are thinking about this, but we have questions. We don't know the answers yet, and it will be important to see how the others will see this. There will be another panel on digitalization, especially on the central bank digital currency. Here again, we have many, many questions, and we want to learn about you, about the panel, how they think about this. For me personally, the most important issue is whether the central bank digital currency serves the interest of the customer or serves it better than the existing payment system. Because if you don't have customer experience better than in the existing payment system, it will not be easy to explain that we will start something completely different. If the customer journey approves, then central bank digital currency must be part of the payment system of the future. We will see how the panel will answer these questions, and the most important question, because per se, just because it's fashionable, we should not introduce central bank digital currency, only if it serves the customer's experience, customer's interests. We will have a keynote speak, and thank you very much, Catherine, for accepting it. Madame Mann is an absolutely experienced and seasoned, highly decorated economist, and she is lucky because she can combine, you know, the commercial banking, central banking, and experience in international bodies like OECD, with Citibank experience, Federal Reserve experience, and now being the board member of Bank of England, we are really blessed to have you here. And the most important speech of today is the acceptance speech of Robert Holzmann, the governor of Austria, Austrian Central Bank. He is not less seasoned than Madame Mann. He was everything in the past decades, and he has a huge and very broad intellectual agenda and a huge body of work, which proves that he is really the right person to be awarded by the Central Bank of Hungary. So thank you very much, and I wish you a good learning experience, and have a good day.
If you give me a bit more time. Okay. Thank you, Governor Patai, for the inspirational introductory remarks. Now, it is my pleasure to give the floor to Mr. Robert Holzmann, Governor of the Oesterreichische Nationalbank, the winner of the 2023 Lámfalussy Award, who will be the one to give the Lámfalussy lecture.
Thank you, Governor Patai, Excellencies, ladies and gentlemen, dear colleagues from the banking community and from academia. Let me start out by once again thanking the Hungarian National Bank to award me with this prestigious prize, the Lámfalussy Prize. We had yesterday a very, very good session. We had a beautiful concert. We had a great gala. We had drinks, as Governor Patai mentioned yesterday. So I feel fully empowered to give her the speech here today. And I feel honored to receive last year's Lámfalussy Award. And I have to say, first and foremost, because of the outstanding personality to whom this recognition is extremely linked. Alexander, or as known in Hungary, Sándor Lámfalussy. His extraordinary accomplishments are so numerous that it would be difficult for me to list them all, because he belongs to those illustrious groups of polymaths in public policy making. Lámfalussy shaped both European and economic monetary integration, and he left a lasting imprint on our current regulatory architecture for banking and for financial markets. In the central hall of fame, Alexander Lámfalussy would no doubt have a place of honor. And yes, you are aware, Mr. Lámfalussy's career did not only be confined on central banking. He worked also as an academic, as a commercial banker, and also in a variety of leading positions and international organizations. So as some of whose career is also spent different sector and varieties, I can personally very much relate strongly to his professional past. I dare say, however, that we also share additional, perhaps more fundamental values. Most importantly, Lámfalussy was a convinced European and an advocate of European integration with all his heart. At the same time, in this relentless fight for the European cause, Lámfalussy was never afraid to float new ideas and to speak out his mind, even though his vision sometimes contained inconvenient truths, and they were not always shared with the majority of peers. For example, in his memoirs, he recalls speaking in favor of European monetary integration to financial professionals in New York in 1994. And at the time, this project seemed to be surrounded by much skepticism when he recorded that, quote now, "What few people in the audience were looking at me and thinking, poor guy, what has he got himself into that?" Luckily, he did not get up. As a matter of fact, I had a similar experience, but 20 years before in 1972, with my initial doctoral thesis project entitled Simulation Analysis of European Monetary Integration. At the time, nobody in Austria understood what I was talking about. People back then totally unfamiliar with computer-based modeling methods and the economic content of my proposal, European monetary integration, and consequences, the financial support I requested from the Austrian National Bank was rejected. So instead, I turned to simulating a pension model, and this became a lifetime fascination, which happened to link me with other topics, monetary, capital market, labor markets, to all from what I profit nowadays. In this Lámfalussy lecture of today, I will establish a connection between some of Alexander Lámfalussy's contribution to our profession and more recently, including my own topics. Of course, Mr. Lámfalussy's work harbors a large reservoir of ideas, and they have to be selective. I will only highlight a few themes, particularly those close to his and my heart. And I must apologize because, as you have expected, my selection is necessarily biased. Given my current role as a governor of the Austrian National Bank, but also because in the midst of the episode, and Deputy Governor already alluded to the strong inflationary headwinds, I cannot help but to say to focus on topics which are linked with the area of European monetary policy. I plan to divide my short lecture in three parts. First, I will briefly look back on the period preceding the current return to inflation. Second, I will look at the present challenges we face. And third, I will look ahead and reflect on the future monetary policy, broadly speaking. Through my intervention, I will try hard to stick to Lámfalussy's mantra, quote, "Monetary policy, like other policies, remain an art, not a science." True to his belief, I will do my best to follow into his footsteps by scrutinizing received wisdoms. Let me start out by looking back. For this purpose, I will refer to one of Lámfalussy's first academic contributions, his 1961 book entitled Investment and Growth in Mature Economies, The Case of Belgium. Essentially, this book is published the content of his PhD thesis at Oxford University. Lámfalussy observed an intriguing pattern. In post-war Belgium, the most significant increases in capital stock happened in sectors that were generally seen as being in decline. He explained this phenomenon. Lámfalussy coined the concept of defensive investment. He argued that defensive investment functions as a protective device in staging or declining sectors, in particular, quote, when profits are squeezed, when competition is active, when lowering costs becomes a matter of survival rather than of expansion, unquote. Lámfalussy concluded that while defensive investment may have saved some of the staging and stagnating sectors in the short run, it will likely hamper the scope for productivity increases in the medium to long run with negative knock-on effects on potential output. Now, how does Lámfalussy's early work relate to my goal of looking back in the period preceding the current return of inflation? Well, by establishing an intellectual bridge, I will concentrate on one defining feature of the euro area monetary policy during the last decade: highly accommodative, unconventional measures, such as negative interest rate, such as asset purchases, such as funding lending schemes to private banks itself. It was 10 years ago, this past July, that Mario Draghi gave his famous whatever it takes speech, so it's time to sit back and reflect a little bit on the use of these unconventional methods. To start with, a standard view in a policy circle is that unconventional monetary policy, or UMP, had a prominently positive economic impact. Indeed, there are good reasons to believe that non-standard tools helped the euro to overcome the predicament of an effective lower bound of nominal interest rates and stimulate aggregate demand. At the same time, however, many, including myself, have repeatedly argued that highly accommodative monetary policy can produce severe side effects, in particular on productivity. In the presence of financial frictions, very low interest rate levels can contribute to survival of new market entry of low productivity firms by easing their financing constraint and by reducing incentives to repair their balance sheets. In other words, a highly accommodative monetary stance may contribute to creating an environment in which productive firms have as incentives to engage in defensive investments, to prolong their survival rather than promote expansion or innovation. In theory, low productivity dynamics could have compounded the COVID-19 pandemic's scaring effects on potential output. Whether and to what extent this combination in turn complicates the current mismatch of the supply and demand sides in our economies is a question that still remains to be fully answered. Against this background, it seems only fitting that Lámfalussy should have argued in favor of drawing up plans to exit from the unconventional monetary policy very early on. The plea he made at the dinner address on the 6th ECB Central Banking Conference in 2010 predates the peak of our balance sheet expansion for many years. Needless to say, it also preceded more than a decade the by now more mature view that euro area and other central banks, we should start tightening, quantitative tightening. And I'm happy to report that the European Central Bank will start the tightening as of the 1st of March in a few weeks' time down the road. This brings me to the present challenges we face in the euro area, the second part of my lecture. In 1981, Lámfalussy published a BIS paper bearing the title that it has lost none of the topicality: Rules versus Discretion, an essay of monetary policy in an inflationary environment. In this paper, he addresses some of the most pressing questions that dominate our current monetary policy discussion. In particular, he raises the question how to minimize the short-term cost and trade-offs of anti-inflationary policy. And even back in 1981, his answers to these questions were decisively modern. In his view, the crux of effectively fighting inflation at minimum costs lies in diffusing the public inflation expectations. Keeping inflation expectations anchored, as we would say nowadays, minimizes the periods of transition back to price stability and thus also minimizes output and employment losses. Well-anchored inflation expectations considerably reduce the extent to which high inflation rates become ingrained in the system, for example, through wage price spirals. Moreover, according to Lámfalussy, the most effective anti-inflationary measures are measures that bite. People tend to give pride to the places of most facts that affect their daily life rather than to statistics. That's a quote by him. He thought that while he promises the future convergence to fix rules to target may serve a useful role, actions and results that substantiate these commitments are at least as important. What can we learn from Baron Lámfalussy's thinking of more than 4 decades ago? Well, a great deal. As I argued in a recent presentation in Warsaw, monetary policy must be credible, now more than ever. Monetary policy credibility is crucial to maintain inflation expectations anchored and to minimize the cost of inflation. For precisely this reason, we, the members of the Governing Council of ECB, did not disregard the influence of the current inflation surge by taking a wait-and-see strategy approach. Ultimately, the losses we as a euro area policymakers incur by consistently missing our inflation target at our own peril. Inaction or weak action in our fight against inflation would have backfired, as it would have eroded the public confidence in our commitments to price stability. Our timely response was a key of keeping inflation expectations close to the target. Nevertheless, current inflation rates in the euro area remain too high. More importantly, people clearly continue to feel the impact of inflation in their daily lives, and we see it ourselves in the newspaper every day. Hence, today, the risk of over-tightening seems dwarfed by the risk of doing too little. So I think I may consider myself at least a partially Lámfussylian when affirming the following: our monetary policy must continue to show its teeth until we see a credible convergence to our inflation target, a convergence that is also felt by the public, and this was our decision last Wednesday. Yet, as to do justice to Alexander Lámfalussy's legacy, I should emphasize he was also a man of caution, despite or because of his avant-garde thinking in many areas. And this remark leads to my third part and last part of my lecture. Looking ahead, I dwelt for some time onto the question how Mr. Lámfalussy, as a cautionary inventor, would have thought about the idea of monetary policy in the euro area. Where would he have seen the fault lines and the pitfalls? Which modern developments in our policy-making practice would he have considered problematic? When skimming his contributions to revolving themes caught my attention. First, Lámfalussy repeatedly warned against the temptations of overburdening monetary policy. Also, he recognized that navigating uncharted waters was sometimes necessary He highlighted the limits of monetary policy, what monetary policy can and what should do. Now, as we know, over the past few years, a lot has been said and written about economic and financial heterogeneity in the euro area, including the ramifications for monetary policy. The ECB certainly has power to address short-term financial fragmentation in the euro area whenever it impairs the transition of its monetary policy. Still, in the medium and long term, ECB instruments cannot substitute for genuine market-driven integration of capital markets. And as so often, Lámfalussy's contributions do not only point to the underlying problem, he also suggested the cure. As the committees of wise men under his chairmanship reminded us in 2001, only a tightly knit capital market could create the level playing field necessary to absorb asymmetric shocks to prevent the occurrence of diverging financial conditions across the euro area. I certainly concur with this vision, and forging a European capital market should constitute the economic, political, regulatory priority for the European Commission, the EU. However, I heard this request over the last 20 years, and it shows up every time. And again, this time, I hope we will have more chance very soon. A unified capital market would ease frictions, inhibiting firms' access to external finance, and most importantly, equity finance. Only a truly developed capital market union can break the sovereign bank nexus, revive cross-border transactions, and facilitate risk sharing in the euro area. A capital market union would provide the best mechanism for funding promises endeavor, thereby boosting productivity and growth, and can also contribute to more independence of the central banking funding and those reduced future risks linked to the asymmetric transformation of monetary policy in the euro area. A well-integrated capital market union may also reduce the need for intervention in the case of asymmetric shocks. As American experiences suggest, US regions tend to buffer asymmetric shocks quite rapidly by international standard, not least because of the great factor mobility, including private sector flows, and facilitates hence the adjustment process. A specific vision of Monsieur Lámfalussy was that the European Capital Market Union should be based on enhanced liquidity, which will benefit all companies and mostly SMEs. Liquidity, however, will not fall, quote, fall from heaven like manna, unquote. So where is it supposed to come from? Well, in my view, the rules of harmonization, as valuable they are, and the advances in financial market regulation, as impressive they are not enough. Efficient and sufficient, effective capital markets require capitalists. Yes. In a modern democracy, cheap and liquid capital markets are best achieved through savings motivation that are common to all individuals over the life cycle. Housing ownership and retirement financing, and the related financial markets institutions. In fact, my own previous work argues that private pension funds can provide particularly important impetus in this context, and if and when the right reforms are enacted and the right institutions are created. I think Hungary has an example and some experiences in the area. Let me now turn to the second revolving theme that caught my attention and finish my speech. I stumbled upon a fascinating passage in one of Mr. Lámfalussy's articles published in 1985, just before he took over the general manager of the Bank of International Settlements. There he noted his, quote, nostalgia for one of Schumpeter's main theme, namely that economic analysis should concern itself with the process of change, with its succession of cumulative and compensating imbalances, rather than with movements around some identical states of equilibrium, unquote. I was intrigued to figure out what exactly Lámfalussy had in mind when referencing to Schumpeter's idea, which are very dear to my own. Even though the paper's title on the changing environment of central banks' policies seemed too suggestive, I was somewhat disappointed when I continued my reading. Unfortunately, he himself stated quite cryptically that he was only beginning to have an inkling of what Schumpeter was driving at. So instead, and this will be my last part, I would like to share my own personal interpretation with you. If you know me and my recent publications in my new position, you will understand that I immediately connected the role to one of my hobby horses topics as monetary policy maker, the concept of equilibrium interest rate, or A**. I understand Ms. Mann will come back to that. A**, the equilibrium interest rate, is considered an important guidepost for monetary policy. In theory, the level of our policy interest rates relative to the level of A* should determine the stance of monetary policy. Policy rates below the equilibrium interest rate are seen as accommodative and vice versa. In other words, for monetary policymakers, A* embodies Alexander Lámfalussy's reference to the identified state of equilibrium. There are, however, two well-known conceptual issues that complicate the interpretation of A* as a guidepost for monetary policy. First, A* is not, in fact, directly identifiable. It can only be estimated by different measures. By definition, A* is an unobservable variable that can rely on with some uncertain and quite volatile estimates. Second, A* is quite likely endogenous to monetary policy, just like it is endogenous to other economic policies. My view is that the difficulty of estimating A* and the potential of endogeneity do not automatically obviate the usefulness of A* for monetary policy making. In fact, the endogeneity of A* may have a small or stark silver lining. The very idea of endogeneity implies that we can influence the equilibrium interest rate with the right economic policies. Available estimates indicate a major decline in A* across regions of the global north, in particular in Europe. A low and negative A* is a key reason for the deployment of unconventional monetary policy, be it negative interest rate, quantitative easing, and lending schemes. As I argued earlier in my lecture, the accommodative monetary policy stance that comes with UMP can produce severe side effects. Thus, as economic policymakers, we may have an interest in substantially and sustainably moving away from UNP by raising A*. Alternatively, and I think this might be a sensible option, the endogeneity of A* makes it possible to actively use non-monetary structural policies to initiate a strong rise in A*. In my view, the most important levers to achieving this end are policies that boost productivity, that increase the labor force participation of the elderly to compensate for population aging, and reduce the savings glut in the global north by transfers of productive investment towards the global south. For example, a broadly conceived green agenda, a topic of later of this day, would offer new opportunities in all three areas. Hence, altogether, I can perhaps read Alexander Lámfalussy's nostalgia for Schumpeter as a very early expression of skepticism as regards to simplistic equilibrium thinking in macroeconomics. In Lámfalussy's musing, may serve as a wake-up call to regularly scrutinize the radical underpinnings of our monetary policy toolkit to keep it fit for purpose and future-proofs. So let me enter with taking a step back from Lámfalussy's recipe for success. What made Alexander Lámfalussy an effective in weaving fresh thinking into sometimes admittedly rigid fragments of European institution and policy making, you may ask? As the late Wim Tussenberg once suggested, one of the secrets of Baron Lámfalussy's success was his almost innate capacity as a central banker, heart and soul, to find compromises. And hopefully we will be able to make compromises, but we still have to have the right thinking. Thank you very much.
Thank you, Governor Holzmann, for the engaging lecture. Now, I am delighted to invite on stage Mrs. Catherine Mann, external member of Monetary Policy Committee of the Bank of England, to deliver her keynote speech.
Well, I'm delighted to be here in the region. I think I have slides, yes. Turning points in monetary policy strategy. Well, that's what we are working on today as central bankers. But it turns out it's also a topic that brought me to the region in 1992. I was working at the Federal Reserve Board at the time as an economist, and I was sent to the Central and Eastern European new central banks in Poland, in Czechoslovakia, because there was only one of them back then, and Hungary. And I came here to talk about what central banks do. There was a major turning point in the region for what central banks should do, what the way economies were going to be structured. And so I feel like I am coming back to Hungary to talk about these topics. I will be talking about them primarily through the lens of the advanced economies, but the lessons, I think, are equally valid. So over the last week or so, many advanced economy central banks, the Fed, the European Central Bank, and the Bank of England, increased their policy rates, although some by less than before, and indeed some paused. It seems that at least some central banks are seeing a turning point in data to which they are responding with an inflection in their respective policy paths. What's everybody been looking for, and what maybe have they seen? Turning points, we have to remember, may occur at different points in time, in different parts of the macroeconomy, and in different regions around the world, even when they are hit by a common shock. Relevant turning points relate to the mandate of the central bank as well. Inflation is key for all central banks, but some have to be equally mindful of other metrics of macroeconomic performance, for example, employment. Now, one approach to identifying turning points puts substantial weight on forecasts from large macroeconomic models. I've built those myself, because these take account of complex interrelationships among economic variables and policy. But one must be humble these days, in particular, about the stability of these relationships, for example, of inflation dynamics and the monetary policy transmission mechanism. So it makes sense to complement the macro forecasts by looking at a range of more granular data. So let's start to look at where we are in terms of the top line, headline inflation. Is there a turning point visible in the data? For the US and the Euro area, probably that's true. There's a turning point in headline CPI. But for the UK, well, maybe there's stabilization. Is stabilization, in my case, a signal that we're done? Or do we need to wait longer, including for other parts of the economy to turn, before a policy pause or reversal is appropriate? Now, a closer inspection of that chart shows that inflation components, particularly exposed to external drivers, are not all moderating. We have to remember that energy prices are capped for now in the United Kingdom, and goods prices are decelerating, but food prices continue to surge. Now, importantly as well, services inflation, much more domestically driven, posted a 30-year high in December and has been running at over 6% for 5 consecutive months. The stabilization of headline inflation, therefore, at least in my case, is not yet the harbinger of a turning point towards the sustainable return to the 2% target. But maybe a turning point's in the offing. Let's look at the next chart. A simple view of the inflation process is that inflation comes from too much demand relative to supply. Frequently, this is also termed the output gap. And based on this simple assessment, this chart 2 shows the demand side for the 3 regions, and therefore sheds more light on the region inflation behavior. Now, for the UK, during the pre-COVID period of 2010 to 2019, GDP was about on trend. Supply equaled demand approximately, and inflation was on target at 2%. Now, you can see that the UK's demand condition is notable in failing to return to the pre-COVID level of GDP, much less getting anywhere near its pre-COVID trend. You can see the differences in the UK, both supply and demand, in comparison to the US and the Euro area. Yet even though there has been so much of a deceleration in supply and demand, inflation remains stubbornly high. So what's going on here? All 3 regions faced a sequence of shocks to both demand and supply. First, the COVID shock, then Russia's invasion of Ukraine, with implications that are actually more dire for the Euro area and the UK. However, the UK has also been affected by a 3rd shock, which makes it unique. No other country chose to unilaterally impose trade barriers on its closest trading partner. Focusing on the supply side now for the UK, which you can see in those dotted yellow dots, it appears that early retirement and long-term illness have reduced labor supply, and Brexit has reduced trade and investment efficiencies. The bottom line is that supply weakness can be an important ingredient in the search for turning points in inflation, even if demand is weak. So let's turn now to other indicators of macroeconomic turning points. Let's first look at the labor market. Rising unemployment is an ex post indicator of the business cycle, not a harbinger. But early warning of turning points in the labor market can foreshadow a turning point in wage growth, which might herald a turning point in the rate of price inflation. The vacancies to unemployment ratio, which is shown in this chart, is a leading indicator and summary statistic of labor market tightness. While that ratio has fallen in recent months, particularly for the United States, also for the Euro, also for the United Kingdom, a little bit for the Euro area, it remains in all cases at record highs, this VU ratio, driven both by high vacancy levels and low unemployment rates in the UK. This is a unique combination historically of the UK labor market, which highlights why current labor market conditions don't resemble the behavior after previous supply shocks, such as in the 1970s. Now, the VU ratio may not be as good a bellwether for a coming recession, but it may be useful when thinking about wage inflation. If there is a mismatch between UK labor demand and supply, in part driven by changes associated with COVID and lockdowns, in part due to changes in production costs for firms, then wage growth could stay stronger for longer, presenting an upside risk to inflation. But the labor market is just one source of information about turning points. I was the chief economist at the OECD, so of course I have to use some OECD data. The OECD's composite leading indicator provides a quantitative assessment of early signals of turning points in business cycles, and it draws on a vast amount of data to do so. Now, a fall below the long-term average indicates a negative deviation from trend, and thus warns of recession out into the future. Now, the UK indicator is quite notable as an outlier compared to either Germany or the United States, with a very large negative deviation from the long-term average. I think what we're seeing in this case, in the CLI, is that it's telling the same story, that the UK suffers not only from COVID and energy shocks, but also the negative supply shock, basically the worst of all worlds. Now, financial market measures, particularly the yield curve, can also be used, get to the yield curve here, can also be used to infer market participants' perceptions of turning points for demand and inflation. Now, in normal times, yield curves tend to slope upwards as investors demand a premium for holding longer-term bonds. When the slope turns negative, some see an indicator of recession coming on. For expectations of shorter-term yields to be higher than long-term yields, markets must either expect central banks to tighten in the short term and thereby induce a recession and disinflation, or else they anticipate central banks needing to cut interest rates at some point in future in response to a recession. So either way, it seems like an inverted curve points to a good recession indicator. However, we have to look a little bit deeper, and that's why there's a long time series here. It shows that since the 1970s, the UK yield curve has been positive almost all the time, and it turned negative in 2022 for the first time. Now, one of the things to remember as a caveat to whether or not we are thinking about these as recession indicators is that yields are highly correlated across the major economies, increasingly so, as you can see, as the time series goes up to the present. This is, of course, the so-called global financial cycle. Therefore, the signal for any one economy is likely to be mixed about the general direction of the world economy, and in particular, the United States. Now, inflation expectations, which Robert also mentioned. In my case, I particularly focus on the full distribution of inflation expectations. These have been very important in my policy decisions. Now, in previous speeches, I have referenced the decision maker panel, the DMP survey of expectations of firms, UK firms, of their own prices 1 year ahead. In other words, what they think they can sell their product for 1 year ahead. Now, this distribution has had a right tail, a fat right tail, that has been increasingly fat and increasingly on the right-hand side of the distribution for the entire time that I've been at the Bank of England since September 21. Now, I can say that the most recent evidence from January, although still skewed to the right, the right tail of the distributions has started to tighten, and the mean expected price 1 year ahead has fallen somewhat, although only to 6% expectations 1 year ahead. That's a long way away from my 2% target of 2%. So what I'm going to show you instead here is household expectations, the distribution of household expectations. And I see these as particularly important for inflation dynamics, because only if households are willing to pay up can firms realize their expected pricing power. Now, what this chart shows is the difference between point estimates of the right and left tails of the household inflation expectations distributions 2 years ahead, which takes us to 2025, which is near the end of the MPC's forecast horizon. This is a measure of asymmetry in the distribution of inflation expectations. Now, you can see that it peaked in Q3 2022, but that was when energy prices and mortgage rates were also at their peak. We've moderated the yield curve somewhat, and we've moderated household expectations somewhat, but 2 years ahead, it still is positively skewed, and at 4.5% overall on average, again, well above a target consistent expectation. So I've given you a lot of information about the granular and higher frequency data that I tend to look at when I search for turning points. Now I'm going to move to show you another chart, which is going to give you a reason for why I look at all these granular data. These are the macroeconomic forecasts for the UK economy and how they have evolved over the last year according to the vintages of the forecasts. These all come from the Monetary Policy Report, in which the MPC, the Monetary Policy Committee, sets out its best collective judgment about the likely evolution of the UK economy over the next 3 years. Obviously, predicting inflation has been particularly difficult over the past few years, as you can see how those vintages have moved over time. Now, it's not surprising that the macroeconomic predictions haven't been able to keep up with the number of inflation shocks. What I'd like to have you focus on is the medium term, where all inflation in all these vintages is to be projected at around 2% by the middle of 2024, after which it either falls further or not, depending on the forecast vintage. These projections incorporate conditioning assumptions of announced fiscal policy and the market's expectations for the bank rate. But they also reflect econometric methods and past economic relationships. Broadly speaking, the deceleration of inflation in the forecast in 2025 comes from, on the one hand, the assumption that global energy, food, and goods prices are expected to stop rising as dramatically as they did in 21 and 22, but also that the expected weakness in demand relative to supply should discipline price and wage setting. That's why I look at expectations. Is there discipline on the horizon? If you get the first and then the second in the annual calculation of inflation, high monthly increases should drop out. This is the base effect. And that followed by low growth or decreases in the inflation rates as pricing disciplines take over. Is this happening in the data? So let's look at the next chart, where I'm looking at the comparison between, on the left-hand side and the right-hand side, we are looking at 3 month over 3 month annualized inflation rate. So it gets a picture of a higher frequency behavior of inflation dynamics, higher frequency than looking at annual data. The UK inflation looks different from the US or the Euro area. It shows a steady acceleration throughout 2021 and 22, and inflation rates have firmed at around 10% in headline and 6% in core on a 3-month over 3-month annualized basis. So there is no disciplining in these data that we can observe at this time. There's no clear turning point in the UK. So I'd like to skip that one. I'd like to turn to thinking more seriously or deeply about the implications of this for monetary policy. We've looked at macro models, and we've looked at granular data for turning points to help evaluate whether monetary policy has been sufficiently restrictive for long enough. A seemingly more direct criterion is the Taylor principle. That is, in response to an unexpected increase in inflation, the nominal interest rate must rise by more than 1 for 1, such that the real rate increases. Now, this is pretty easy to do if you're in a theory environment, but it's much more difficult to do in practice. Real rates are difficult to estimate, even more difficult than R star. Here is an example of one effort to estimate the Taylor principle in practice using 1 year ahead UK government bonds deflated by households' inflation expectations for the year ahead. Now, if we think that expected real rates are what determine consumption and investment decisions, a falling real rate ought to make those cheaper and stimulate the economy, and a rising real rate ought to make these more expensive and so slow the economy. Now, you can see that what happened in the 1970s is that nominal interest rates rose, but never enough to offset the rising inflationary momentum. So real rates fell, which allowed inflation to become entrenched. Now, I contrast that with where we are now in the UK, where over the last couple of quarters, despite rising inflation, we have been successful in keeping real rates from falling. So I don't view the 1970s de-anchoring of inflation expectations as something to be concerned about. However, I'm going to conclude by saying, why then should we keep raising nominal rates now? First, the real rate is as much about expectations about future inflation as it is about expectations of policy. If we are perceived as being complacent about inflation, nominal expected yields may come down too soon, mechanically decreasing real rates and prematurely loosening the stance of monetary policy. If there is uncertainty about the degree of inflation persistence, it is better to assume a higher degree because the costs of making a mistake, if the true inflation process is more persistent, are larger, in other words, more costly in terms of the inflation output trade-off, than if the true inflation process is less persistent. Second, I think I've identified material upside risks to our inflation outlook. To achieve target consistent CPI, the moderation of inflation has to be as rapid and complete on the downside as its ratchet up was last year. Stickiness of 1 year ahead expectations and even more stickiness in 2 and 3 year ahead expectations, virtually any length of contract period, these all point to upside risks. This would again decrease real rates, which would require us to raise nominal rates for higher and for longer. From a risk management point of view, monetary policy has to lean against these upside biases, since wage and price inflation are still so high, 6% or higher. So third, why don't we wait and pause the hiking cycle to see if inflation dynamics are what I think they are? If inflation is more persistent, then bank rate, in fact, will need to rise again after the pause, to be followed later by a reversal. In my view, a tighten, stop, tighten, loosen policy boogie dance looks too much like fine-tuning to be good monetary policy. It's hard to communicate, and it's very hard to transmit that through the real economy. So to conclude, from a turning point assessment, I am looking for a significant and a sustained deceleration in higher frequency price increases and in the underlying inflation measures and expectations that are consistent with the 2% target. Uncertainty around turning points should not motivate a wait-and-see approach, as the consequences of under-tightening far outweigh the alternative. We need to stay the course, and in my view, the next step in bank rate is still more likely to be another hike than a cut or a hold. Now I want to have 30 seconds. I've been talking about turning points, but in light of one of the topics at this conference, I'd like to highlight a turning, or more appropriately, a tipping point. That is the tipping point on climate change. The Bank of England has been a leader in assessing the implications of climate change for central bank policy, from former Governor Mark Carney, his speech breaking the tragedy of the horizon, the climate biennial exploratory scenario, a founding member of the NGFS, and indeed we did some implementing our greening of our corporate bond portfolio as well. So I'm going to stay tuned, ask you to stay tuned for an upcoming speech to develop in more depth how the broader policy landscape to address climate change has implications for inflation volatility and therefore directly monetary policy. Thank you very much.
Thank you, Mrs. Mann, for the intriguing address. Ladies and gentlemen, as we close the high-level session, a lovely coffee break is coming up next, and we'll meet again in 30 minutes.